Hey, what's up guys? Are we in a stock market bubble and what can you do about it? In this video, I'm going to look at a series of charts and graphs and I'm going to make the case for whether we are in a market bubble right now. And as always, I'm going to give you my thoughts on what's the best course of action, just in my view, of course, through your own research. So let's get started, guys. So are we in a bubble akin to the dot-com bubble? Well, let's have a look at some charts. First chart highlights the percentage of loss firms in the top 1500 stocks. So we're looking at S&P 1500 and we have in the red line here, the red dotted line, we're now close to a little more than 200 companies who are reporting losses for the past 3 years straight. And in the black, you can see the total market value in billions of dollars for these 200 companies. So you're looking at about, between $2 trillion and $2.5 trillion the market is assigning to these companies. The market is saying they are worth $2.5 trillion and they're losing money every year for at least the last 3 years. The only other time we had that situation, if you look at the chart, yes, the dot-com bubble. Another disturbing chart here is cumulative S&P 500 price growth in orange compared to the cumulative earnings growth there. In the short run, no one knows what a stock price will do, but in the long run, the correlation between prices and earnings is very, very high. When the price starts to get ahead of the earnings, you have a problem there. It's going to have to correct. Interestingly, we have corporate debt and corporate profits. So in blue, corporate profits have been going up, but the debt levels have been rising much faster. So the problem here is that when you take on corporate debt, when you borrow money and you buy your own shares back, you're not producing any profits. Hence the big gap between debt and profits. But you are boosting your earnings per share, which is a major objective for a lot of CEOs and CFOs. And as I just pointed out, buybacks are now accelerating. You see that spike there. Who's doing the buybacks? Well, there's a lot going on, but it is concentrated in the tech sector. You see quite a bit in the financial sector as well. There's also a very interesting correlation between real profit margins and the stock market. So the real profit margin there, that's the black line or dark blue line. As that starts to fall, it's a bit of a leading indicator for every market crash here on the graph. So as our corporate profits are falling recently, is that a leading indicator? In other words, if we fill in the rest of this chart here, are we going to see a crash? We can also look at traditional metrics. Here's a price to book value ratio there. So you take the stock price divided by the book value per share, take the average for the S&P 500. It's very high right now. It has really not been this high since the dot-com bubble. We can also look at the Shiller PE ratio. We're currently at about 37. So if you buy the S&P 500, you're paying 37 times next period's earnings. A very rich valuation. You can look at dividend yields. We're at about the lowest mark we've ever been there. The S&P is yielding about 1.37%. If you guys are enjoying the content so far, please hit that like button, hit that subscribe button. It really helps support the channel. I do appreciate it. Thank you guys. Alright guys, so are we in a bubble? Well, I'm not so sure. I mean, all of these metrics are aggregate measures. But as Chuck Carnival always says, it's not a stock market, it's a market of stocks. And yeah, I think some stocks were very overvalued. Some of them still are very overvalued. And I think you're going to finally see some corrections with that. Some of the big winners of 2020 are going to turn out to be the biggest losers of 2021. We already see that with Tesla. You see it generally. For example, here is the ARK Innovation ETF. And it was all the way up to 156 maybe in February. Now it's down to 112, so quite a fall from that level. And you see, things like Bitcoin. Of course, Bitcoin is super volatile, so who knows what will happen. Maybe it'll bounce back. But for right now, I think the bubble is bursting in a lot of these areas. I don't necessarily think there is a bubble in, a lot of other stocks we look at. In other words, there are some good value-oriented companies out there trading at below fair value. If you're generally an index fund investor, you don't have the time to handpick your stocks and monitor them. I very much understand that. And so if you're in that spot, you have a real pickle here in my view. You see the market is very high by any measure. We could very well see a 10, 20, 25% correction this year or the next year. Who knows? And, you're kind of worried about that. At the same time, with the amount of money the Federal Reserve has been printing, you have concerns about inflation. I mean, the last thing that you want to see happen is you take your money out of the market, leave it in cash, and watch inflation just wash away the value of your money. So what can you do? What assets have historically performed well during inflationary times? That's the subject of the next segment. So guys, historically during inflationary times, there's two things that I can recommend to invest in. Number one is commodities, and number two is emerging market equities, or just generally foreign equities. Coming in third, which is kind of a distant third, is real estate. So among those three, the first one I'm going to talk about is foreign or emerging market equities. In your retirement plan, if you have one at work, you're probably limited to picking funds. You can't handpick stocks, and they probably have an emerging markets fund or two. That's something to consider. If you're managing your money yourself, I like VWO, Vanguard Emerging Markets ETF. It has the lowest expense ratio. It yields about 1.8%. Now, if you're still handpicking your own stocks, this is just one thing to keep in mind. We have a lot of inflation. Maybe go with some foreign stocks. That way you can pick the ones you like the best. You guys know I'm long on Alibaba. That stock's been beaten down, but it has a lot of potential, so I'm very long on that one. In terms of real estate, you have House, H-A-U-Z. I love this ticker here. This is an ETF for international real estate, so international REITs. Yields about 3.11% right now. And the expense ratio is rock bottom, 0.1%. And you can scroll down and see their top 10 holdings. They have properties all over the world here, so you're really very well diversified with that one. Alright guys, finally you have commodities. Now commodities actually perform the very best during inflationary times, but to me they carry the greatest risk. If we don't really see that big inflation like I'm expecting, gold, silver, these kind of things, they don't actually produce anything, okay? So you could have very long holding period with not a lot going on with your money, not a lot of return there. So very possible that could happen. I would never bet everything on commodities, but given the inflation environment we're seeing already this year, I did move about 10% of my money into gold and silver for that reason. Of course, if you don't want to own physical gold or silver, there's plenty of ETFs or companies. Here's Barrick Gold Corporation. Just one of many to consider. So at an aggregate market level, yes, we are clearly in a bubble. It is a market of stocks. It's not a stock market, so you can still find value. But if you're an index investor, yeah, it's pretty high right now. The major concern you have is that the Fed is going to have to raise interest rates. If they were to do that, if they were to start increasing those rates, you would see a massive sell-off. You would see big decline in stock prices. That's really the reason for our bubble that we find ourselves in. We have extremely low interest rates, a lot of quantitative easing, a lot of liquidity. Really, we have an excess of liquidity in the market. Now, from my point of view, the Fed will never raise interest rates. And when I say never, I almost literally mean never. It's going to be a long time. Remember, in 2008, when we had the financial crisis, when did they actually raise interest rates after that? The answer, 2014. We raised them by a quarter point. That's how slow it was. This time, we have even more debt. When I say we, I mean the federal government. If Jay Powell were to raise rates right now, he would risk bankrupting the U.S. government. He would risk bankrupting many, many corporations. He can't do it. So although I think we're clearly in a bubble, my estimation is that this bubble is not going to pop for a while. And with the inflation going on, I would rather keep my money in something that's making money. So I'm almost 100% fully invested. Anyhow, that's just my take. I hope you guys enjoyed the video. I hope you got something out of it. Let me know if you did in the comments below. I really appreciate hearing from you. Thanks for watching.